Thank you all for joining in. My name is Martin Norman. I work as an investor engagement lead for ACCR, and I'm very pleased to welcome you to this webinar about the Equinor pre-AGM brief. I am a full disclosure. I'm also Norwegian, so my interest in Equinor goes way beyond just a professional one. And I've been following the company closely for, basically since 2007, when they bought into what they portrayed as an environmental friendly energy project in the Canadian forest, also known as Canadian tar sands. Today, we're going to hear a presentation by our research team in Australia about some suggestions on Equinor's way towards being Paris aligned, at least some first steps. And we looked in detail into some of their investments outside of Norway. And there is also going to be some news, because as this webinar is going on, there will be the notice of meeting for the shareholder, or for the AGM, is coming out. Then be public that there is a shareholder resolution filed by Sarasin and partners and friends. And we are so lucky that we have Natasha Landell-Mills on this call that will also talk more about that a bit later on. But for now, I would say that I'll hand it over to my colleague Alex. Just one thing, this webinar is being recorded. We will share the recording afterwards with all attendees. Please don't quote anything that is being said in or asked in this webinar. But if you have further questions, please contact us directly or me directly, and we will save all the questions you have, or at least most of them, towards the end. And if there are anyone that we are not able to answer during this hour, we will do it in writing later on. So Alex, over to you.
Thank you very much, Martin. So my name is Alex Hillman. I'm the lead analyst covering global oil and gas stocks for ACCR. I've got a background in oil and gas as an engineer with a finance degree as well. And spent almost 10 years with Woodside, so an E&P company, in some ways not too dissimilar to Equinor, but a little bit smaller. So in Australia, we have a practice where we recognise the traditional custodians of the land. So I just let everyone know I'm dialing in from the land of the Whadjuk people of the Noongar Nation. They never ceded their land, and I'd like to pay respects to their elders, past, present, and emerging. So tonight, as Martin said, what we're asking from you is that you support the shareholder resolution filed by Sarasin, which has only just become public, and Natasha will talk to that in detail after Pranav and I. And then also engage with Equinor on the importance of both stopping exploration for new oil and gas reserves globally and halting the development of new oil and gas projects outside of Norway. We think that these measures will protect shareholder value and move Equinor towards long-term Paris alignment, and it will actually avoid 67% of the emissions from Equinor's unapproved projects. So throughout ACCR's research, we've used independent data from the International Energy Agency and Rystad Energy. Rystad's data is fairly complex. They have verified that we have interpreted their data correctly, but obviously we are responsible for any assumptions that we've made when analysing that data and the conclusions that we draw from it. So the context from our research is, I think it's widely understood that Equinor is ahead of its peers and taking commendable steps within the oil and gas sector. It manages its Scope 1 emissions, especially from its operated assets in Norway, extremely well. And the International Energy Agency actually describes them or uses them as the example of best practice. It's also been a leader, an early leader in offshore wind. But its energy transition plan still falls short of the Paris Agreement's goals, and investors are calling for more. So last year, Equinor's largest investor, the Norwegian government, with a majority stake, laid down its expectations of the company. Amongst other things, it called for the company to set targets and implement measures to reduce greenhouse gas emissions in the short and long term in line with the Paris Agreement. In our view, Paris Agreement for Equinor requires 4 distinct steps. So the first 2 of these are commercially pragmatic, and we'll present our financial analysis, and they're the focus of the research of this presentation. And these are stopping exploration for oil and gas reserves globally, and then halting the development of new oil and gas projects outside of Norway. By our analysis, this would avoid 67% of the emissions from Equinor's unapproved oil and gas projects, making a dramatic step or a substantial step towards Paris alignment. Although not the focus of our research, Paris alignment requires even more than this, and that would require stopping the rest of oil and gas project development, so including inside of Norway, and developing a strategy to wind down some of its operating assets, probably those high-cost ones. So I now pass to Pranav, who will explain our Paris alignment analysis and our exploration analysis.
Thanks, Alex, and thanks everyone for joining today. My name is Pranav and I'm an analyst here at ACCR. I'd also like to begin by acknowledging the traditional owners of the land from which I'm dialing from, the Wurundjeri people of the Kulin Nations, and would like to pay respects to their elders past, present and future. Our recommendation for Equinor to stop exploration for new oil and gas reserves worldwide is dependent on a few core reasons. The IEA, the context in which we look at exploration and the Paris goals, the IEA is quite clear and definitive in what the oil and gas sector should act and the way in which they act, which is companies aligned with the results of the NZE scenario, which is the IEA's only Paris-aligned scenario, would not invest in new exploration projects. The rationale behind this statement becomes clearer when we look at what is going on in terms of oil and gas supply relative to the NZE and other scenarios. Those charts at the bottom show that for both oil and gas, existing and approved projects can sufficiently meet the requirements of the NZE scenario, therefore implying that any future discoveries as a result of exploration will be in surplus and not aligned with the NZE scenario or the Paris Agreement. This is what's going on from a broader industry and global perspective, but what does this mean specifically for Equinor? Equinor actually published an article where they kind of went through the reasons for why they see a role for continued exploration through a climate crisis. One of the reasons they provided was that exploration will provide financial muscle required to support the energy transition. This implies that exploration and the assets that are developed as a result of newer discoveries will generate cash flows that can be redirected towards the energy transition. Although exploration outcomes are inherently uncertain, Rystad have modeled what future discoveries for Equinor could look like. We analysed the cash flow from these assets, and at a portfolio level, we found that Equinor is unlikely to generate positive cash flow until after 2050. Which will be too late to start redirecting funds towards the energy transition and therefore is not Paris aligned. We also broke this down at a project level, looking at the Equinor's historic time, the period from time of discovery to start of production. And we found this to be about 13 years, which is also similar to what the IEA suggests as a global average. So not accounting for the time actually required to make a discovery, for a field discovered today, it will be at least 2037 until it comes on stream, which will again be too late to start redirecting funds towards an energy transition. A second reason that Equinor provides to continue exploration is to provide the world with safe and stable energy. As we saw from those couple of slides ago, there is sufficient supply from existing and approved projects such that no new projects are required and exploration is not needed. Therefore, Equinor's discoveries will be producing a surplus beyond the requirements of a Paris-aligned world and the NZE scenario. For context, the NZE scenario considers recent geopolitical events, has a priority for energy security and also an equitable transition. Another thing we found was that 55% of reserves from Equinor's future discoveries will remain unproduced in 2050. And what this means is that they will be supplying energy too late to support a transition, and in a world where there will be heightened risks for the demand expectations in the oil and gas sector, given the energy transition. The back-ended nature of the production profile of future discoveries also means that they will not be able to supply safe and stable energy in a meaningful way in the short to medium term, and they also create risk for locking in fossil fuel dependence post-2050, particularly in emerging and developing economies as they develop, which is another risk. So based on these reasons, we see stopping exploration for Equinor as a reasonable first step towards moving closer to Paris alignment, and a step that will actually free up capital that can be reallocated relatively quickly. Our second recommendation for Equinor is to stop the development of new unapproved oil and gas projects outside of Norway. And this again is grounded in a few core reasons. One of the things we need to understand is whether or not these projects are or aren't Paris aligned. I'll digress a little here, but it's really important to understand that global emissions from the oil and gas sector have increased now since the Paris Agreement was signed. What is happening is that companies continue to pursue greenfield and brownfield expansion projects while also claiming to support the Paris Agreement. This is happening at the same time as the IEA continues to implore that there is no need for new oil and gas, long lead time conventional oil and gas projects. This essentially creates a dichotomy where companies are able to justify their portfolio and future expansion projects, whereas as a global collective, we keep moving further and further away from the goals of the Paris Agreement. The reason this is happening is because there is too much discretion allowed currently in companies' climate targets reporting and their Paris alignment communications. And some examples that we see across the industry, not just Equinor, include the use of intensity targets rather than absolute emissions targets and goals, which essentially intensity targets can be reduced through oil to gas ratio switching, for example, while absolute emissions can continue to increase. Other examples include treating divestments as emissions reductions, wherein the net output of emissions globally do not decrease, but a company on paper can report an emissions reduction and justify future projects. Selecting base years with higher than normal emissions, such that which has the effect of exaggerating the emissions reductions in future years and can therefore create more room for projects that can be justified as Paris aligned. There's many more, but the end result of this is that financial assumptions that are not Paris aligned can continue to justify investment that is not Paris aligned. And in this way, as a global collective, we keep moving further and further away through non-Paris aligned decision-making in the oil and gas sector. This essentially, companies are essentially able to present a last person standing argument through the energy transition, which cannot be true for all companies. So just going back to these oil and gas supply charts, we can see that the IEA actually gives a breakdown of which category of projects is and isn't aligned with the NZE or Paris NZE scenario. And we're able to draw the blanket conclusion that existing and approved projects are a significant proportion of existing and approved projects are aligned, but we aren't able to actually specifically identify which projects are and aren't aligned and to which degree this alignment / misalignment occurs. So what we actually did was use Rystad data to break these categories down at a project level and create a system where we can analyze a given projects or a portfolio of projects alignment with the Paris Agreement. So our methodology essentially involves assuming all operating and under development projects operate to their end of life, but for unapproved projects, we rank them from lowest to highest break-even price. And in doing that, we're able to generate a global least cost view of how unapproved projects sit relative to the Paris Agreement, and also how they sit relative to all other unapproved projects on a least cost basis. I'll explain this a little bit more in the next slide, but the key benefits of this method includes that it removes the opportunity for companies to select a range of self-selected voluntary targets and metrics to show and demonstrate their Paris alignment, as it benchmarks them all on a global perspective, essentially removing the last person standing argument. It also provides investors with valuable insights into which future decisions will, for project approvals, will and won't be Paris aligned on a global, from a global perspective. So this is just an example of one of the charts we have created, and I'll just explain how it works just to reinforce our methodology. So the dark purple and light purple are the producing and approved projects, which we assume operate till their end of life. Whereas the unapproved projects, we've ranked them from lowest to highest break-even price. And the way we've done that is kind of demonstrated in the caption on the right there. So essentially, as you go higher up on the y-axis, the more expensive a given unapproved project is relative to all other unapproved projects. And by doing this, we're able to search specific projects in a given portfolio or a company's portfolio and identify, for starters, whether or not it is Paris aligned or not, and the degree of misalignment relative to all other projects globally. So we ran this analysis for Equinor's oil projects, and we found that Equinor's international unapproved oil projects are neither aligned with the Paris Agreement, as they all sit above that green line, but they are also outside the top quartile of global unapproved oil projects on a least cost basis, sitting between the 40th to 100th cost percentile. We also found that they have long-term production profiles that extend well beyond 2050, again, creating a risk of longer-term fossil fuel lock-in. That chart on the right shows Equinor's major oil projects that were the focus of this analysis, primarily in Brazil and Canada. We also ran this analysis for Equinor's unapproved gas projects and a subset of their gas projects, the LNG projects, and found a similar conclusion. We found that Equinor's major gas projects in Tanzania are not aligned with the Paris Agreement and sit well outside the top quartile of unapproved projects on a least cost basis. And when we took a subset of that, the LNG market, we also found a similar finding that has been reported by the IEA as well, that there is a forthcoming LNG glut relative to the NZE scenario, where there is no room for approved projects, let alone unapproved projects, and that certain producing projects will also have to shut down ahead of their technical and economic lifetime. And so by doing this analysis on Equinor's unapproved oil and gas portfolio internationally, we're able to conclude that they are neither Paris aligned nor low cost relative to all other global unapproved oil and gas projects. I'll now pass over to Alex to further discuss Equinor's historic performance outside of Norway and the future capital allocation strategy. Thank you.
Thanks, Pranav. So we've seen that ACCR has concluded that the Equinor's exploration strategy is not going to support the energy transition, and that its international growth projects are not aligned with the Paris Agreement. So when I have a look back at decisions Equinor has made to build projects, oil and gas projects outside of Norway, and how they've fared. So again, using Rystad data, we pulled out the free cash flow profiles for each of its international projects. And what we found is that there's $94 billion of CapEx has been spent by Equinor on these projects globally from the point of FID. Again, from the point of FID into the future, the NPV of those projects, so the net present value of those projects, including future cash flows, is minus $3.6 billion. So this $94 billion of CapEx appears to have actually eroded value. This is from FID though, but in order to get access to these projects, Equinor has spent $14.5 billion in both acquiring these projects and in pre-FID investments. So in our view, and our data and conclusions show that Equinor's activities outside of Norway are not generating positive NPV. Further international investment brings specific risks to Equinor because Equinor doesn't have a proven track record, as shown by this data. It often doesn't have operational control of these assets, and it continues to take on emerging market country risk. So that was our analysis using our analysis of Rystad data, but we also checked a few other data points to validate our conclusions. So one of those is Equinor commissioned a study from PricewaterhouseCoopers into its US operations. So this study focused on a $21 billion or a cumulative $21 billion impairments in the US operations over a 12 to 13-year period. So that validates our conclusion that internationally, Equinor's assets and decisions have not done very well. The other point we had a look at was Equinor's shareholder returns. So using total shareholder returns, so the change in share price plus its distributions, we looked at 2 periods. So one of those is from the IPO until 2007. And during that period, the oil price increased significantly, whilst domestic, as in Norwegian production, decreased a little bit and international production increased. During this period, Equinor performed exceptionally well, delivering a 32% per annum total shareholder return. So amazing performance. The second block of time we've taken coincides with when the oil price, although volatile, has returned to its starting price. So between 2007 and 2023, the oil prices has roughly returned to where it has been. And what this time period lets us do is net out the impact of oil price on total shareholder returns. During this period, domestic Norwegian production continued to decline slightly, whilst international production actually accelerated. And through that period, Equinor delivered a 5% total shareholder return on an annual basis. So unlikely that Equinor over that period has met its cost of capital. So we think this analysis of Equinor's TSR supports the conclusion that international development is not a strong source of value. We now look to the portfolio of projects that Equinor may choose to invest in into the future and some of its financial assumptions. So this graph is from Equinor's 2022 Energy Transition Plan, and it shows that not only is Equinor planning to increase expenditure on oil and gas to 2030, it's significantly so for unsanctioned oil and gas projects. This is despite our analysis finding that none of its projects are aligned to the net zero emission scenario and that it has an underwhelming financial record for its international oil and gas projects. What we found when we analysed its portfolio is that its portfolio is not high enough quality to justify higher oil and gas investment, but despite its oil price assumptions encouraging it to invest more than its peers. So starting with its portfolio, Equinor talks about how the projects it's going to bring online in the next 10 years have a break-even price of $35 per barrel. This sounds attractive. It's much lower than today's market price. But when we compare it to Rystad's data, we find that 60% of global pre-FID oil projects have a cheaper break-even price. So that $35 is actually less competitive than the global market. When we look at Equinor's oil price assumption, we find that it's much higher than its peers and that its portfolio is very sensitive to this assumption. So of those 8 companies there, so Equinor, Total, Conoco, Shell, Eni, BP, Exxon, and Chevron, Equinor has significantly higher oil price than any. It's 15% above the average and 20% above the Brent futures price. So we modelled Equinor's international pre-FID portfolio using both Equinor's $75 flat real oil price and then the market futures price. And what we found is moving from Equinor's price assumption to the market price reduces the NPV of that project portfolio by 50%. This suggests Equinor's portfolio of international pre-FID projects is less attractive than it may first appear. Equinor has a long track record of making optimistic forecasts. For example, in 2013, it predicted that its international portfolio had a 3-year payback based on a $110 oil price. Equinor's international portfolio hasn't delivered outstanding returns, however, so we suspect that that historic prediction from 2013 or the guidance it provided in 2013 hasn't panned out. So taking a step back, we're making some recommendations for Equinor to cease global exploration and to stop developing new oil and gas projects outside of Norway. We actually think this could support Equinor's share price because it will provide an immediate sustained free cash flow boost whilst creating minimal downside in the long term. So you can see that free cash flow is impacting Equinor's share price today based off what happened at the 2024 capital markets update. So at this update, the share price, or just after this update, the Equinor's share price dropped 7% over concerns of insufficient free cash flow in the short term. So just to reiterate, our request is that investors support the shareholder resolution filed by Sarasin, and we're shortly to hear from Natasha about that. and also engage with Equinor on the importance of stopping international or global oil and gas exploration and halting the development of unapproved oil and gas projects outside of Norway. We think these measures protect shareholder value and move Equinor towards Paris alignment. They avoid 67% of the emissions from Equinor's unapproved projects. And I'll pass to Martin to introduce Natasha.
So thank you, Alex. I'm always I'm still I'm not impressed by the numbers, but it's depressing numbers from a Norwegian perspective, I would say. I just also want to remind people that it's possible to ask questions. You can use the Q&A at the bottom of your screen, and we'll answer those as we go or at the end. And now I'll hand over to Natasha from Sirenum Partners, and any updates from your end?
Yeah, thank you so much. So I'm hoping you'll be able to put my slides up as well as I begin. But first of all, let me just kind of applaud the work that ACCR has done here. I mean, it's some of the most forensic financial analysis that I have seen that tries to combine a focus on the Paris alignment goals and the transition that's underway with an individual oil and gas company's pipeline of projects. So it's really fabulous analysis, and we're very grateful for it. So yes, as has been mentioned, our shareholder resolution that we have filed alongside 3 other co-filers, Sam Pension in Denmark, a large Danish pension scheme, West Yorkshire Pension Fund in the UK, and Equinor Investment Management, a Dutch investment manager, which is listed there. And that has just been published as part of Equinor's AGM materials today, just about 30 minutes ago. And I'm told that the board has come out to recommend a vote against. We expected that, of course, but we were hopeful that actually the board would come out in favor. So that's a disappointment, but as I say, not unexpected. This is really a culmination of several years of engagement, certainly on our part. We've been long-term shareholders in Equinor, and we've been a co-lead for the CA 100+ engagement initiative, as well as obviously conducting our own bilateral engagements with the company. And as has been mentioned, Equinor really is a leader. I mean, there is no doubt about that in the oil and gas space, particularly on its Scope 1 and Scope 2 emissions, and we have always applauded that leadership. They've also come out very clearly in terms of setting ambitious targets for CapEx going into renewables and low carbon solutions, which is incredibly welcome. But in the end, it's our view that they are not aligned with the Paris goals, as no other oil and gas company is. And before I go through a few of the key points from our shareholder resolution, and I should just warn you that it comes to about 15 pages in total, our supporting statement. So I hope you will take the time to read that. But I did just want to emphasize why this shareholder resolution is so important. First and foremost, as we've been hearing, there are very clear risks to shareholder capital, in our view, to long-term shareholder capital from inadequate attention to demand destruction that's underway from the transition. And I'm going to come on to that. But I think the other point here, and why this deserves international attention, is that of all oil and gas majors, I do believe that Equinor is the best place and the best equipped to make this happen. And by that, I mean shift on to genuinely a 1.5 pathway. And there are a number of reasons for that, but I would say first and foremost, that's because it is 67% owned by the Norwegian government. And the Norwegian government is not only a signatory to the Paris Agreement, it's a vocal supporter of that Paris Agreement. And moreover, the Norwegian government has published a fabulous white paper a couple of years ago, approved by Parliament, which sets out that as an owner in many, many companies, including Equinor, it is committed to acting responsibly and ensuring that its companies align with that Paris Agreement. So we have the core building blocks there. And therefore, if I flip that on its head, if Equinor can't do this, then I do think that we're in trouble, because I can't see how other oil and gas companies will do this. Likewise, if Norway, as a relatively wealthy petro state, can't do this, then I think the hopes for others doing so are dim. And I think we then have to think very seriously about the feasibility of those Paris goals, which anyway, of course, people are worrying about. So I do think that this AGM needs to be put under the spotlight, not just in Norway, but globally. And I very much hope that everyone on this call will take the time to look at our resolution. So let me just read it out. It's not very long. In keeping with Equinor ASA's commitment to support the goals of the Paris Agreement, and considering the Norwegian government's explicit expectations for the company to align actively with the Paris Agreement as per its statement at Equinor's 2023 AGM, the general meeting asked the board to update its strategy and capital expenditure plan accordingly. The updated plan should specify how any plans for new oil and gas reserve development, as we've been hearing from ACCR, are consistent with the Paris Agreement goals. So that's the resolution. As I say, there's quite a long supporting statement, and it's split into two parts. But firstly, just to underline the goal for this, ultimately, as long-term shareholders, as that we believe that promoting alignment with the Paris Agreement goals will underpin long-term economic growth and therefore investment returns. And that's both in Equinor, but also more broadly in other assets that we hold in markets globally. So as I say, the supporting statement has these two parts. One is risks to long-term investor capital from Equinor strategy and capex plans. And the other is evidence that Equinor strategy is not consistent with the Paris goals. So many of these points essentially dovetail what we've been hearing from ACCR, and we cross-reference that report and that work. On the risk to capital side, I'll maybe go into a bit more detail on this, but we've been talking about its project pipeline and actually negative NPV from a number of the projects that Equinor has been prioritizing. But we also have a question mark over impairments within its existing balance sheet, and I'm going to come on to that. In addition, there are legal and regulatory risks around it failing to adhere to the commitment that it has made. And then, as I've mentioned, of course, there's these broader system-wide risks that come from Equinor continuing to pursue a strategy that is not aligned with that 1.5 goal. On the strategy not being aligned with the Paris goals, there are a number of points of evidence in the document, but first and foremost, Equinor itself says it isn't, and that's very clear, and I'll have that on the slide. But I don't think that's a point of disagreement. Actually, they have in their own transition plan in 2022 shown that their pathway sits above the 1.5 pathway for the IEA. And we've already heard that the oil and gas production plans exceed what would be consistent with 1.5, as well as the capex plan. So the next slide, please. So just to start with, before we even think about 1.5 and that scenario, I think it's just important to emphasize that under the existing stated policy scenario of the IEA, which takes into account what's been stated and being implemented, we're looking at unabated fossil fuel demand going into decline by 2030. So oil and gas demand is coming down, whether or not additional policies are pursued. But the trouble is, Equinor, like many oil and gas companies, in fact, pretty much all of them, are not planning really taking into account that accelerating decline. Now, this is a table which I've added colorful boxes onto, but this table is an extract from their latest financial statements, the 2023 financial statements that just came out in the annual report. And what I think it helpfully does is demonstrate the point that that Alex and team were just making around the elevated price assumptions that Equinor is using that effectively underpins its predictions that it will deliver IRRs of 15% or so into the future. Now, in the first column that you see there with the colorful boxes, those are management's price assumptions going forward, oil prices and gas prices, and then carbon tax prices. The middle column and the right-hand column are prices associated with the IEA scenarios, the middle one being the net zero 1.5 scenario, the announced pledges scenario being there on the right. And I think what you can see from this very, very clearly is that while management's oil price assumptions are similar to APS, they are absolutely materially above what would transpire in an accelerated decarbonization scenario of 1.5, which is the middle column. On the gas side, their assumptions are elevated not just relative to that 1.5, but also elevated in relation to the announced policy scenario. And then finally, if you look at the carbon taxes, their assumptions are much lower than the assumptions of those two other scenarios. So in other words, it's optimistic however you look at it. And then, you know, it's perhaps not surprising in that sense that they get high expected internal rates of return. But then they have actually helpfully done some stress testing for us for these lower price scenarios. And in the latest annual report and accounts, two numbers I would draw your attention to. Firstly, in their TCFD climate stress testing work, they look at a 1.5 stress test and they report that they would see probably a 42% hit to NPV. So 42% of the net present value would be destroyed in that scenario. If you look then at the financial statements where they look at a narrower set of assets and they stress test for 1.5 prices, and for that, I mean, they're looking at the upstream assets as well as what they call selected intangible assets, and they estimated 10 billion impairment risk, which actually you can see in the bottom row of that table as well. That's equivalent to 20% of the reported equity at the end of last year. So, you know, material impacts from lower prices. It just serves to really emphasize how important that price assumption is and how, you know, how in a way vulnerable the business is then to this accelerated transition that we're seeing happen. And on the right there, I've just quoted the numbers you've already heard about from ACCR this morning. So again, charts that you've just seen, we also use these in the shareholder resolution, and it just serves to make the point utterly clearly that there really is no space for new reserve development. But under Equinor's planned CapEx, or CapEx plans, excuse me, they're expecting to deploy 20 to 30% of their budget between 2024 and 2030 to new fields, none of which I think really could be considered consistent. And as ACCR has already pointed to, the costs of their pipeline are actually rather elevated when compared to peers, making them even less economic. So this is my final slide. I didn't want to sort of drown you in tables and charts, but this is just one to underline this point on how under Equinor's existing transition plan, they are not 1.5 degree aligned. This is a graph taken from their own plan. And as you can see from the dots on that, they sit above the 1.5 plan, which is the bottom line, and also the sustainable development scenario as well. Now, I would just also emphasize here that since they've published this document, which they're now due to review this year to put to a shareholder vote next year, they have actually extended the period of oil and gas production to 2035 before it starts to decline. So in other words, the dots on this chart, if anything, have moved further up and further away from what would be considered 1.5 aligned, rather than the other way around, which just adds to the concerns. So I'll stop there. As I say, very, very happy to take questions. I really would hope that you'll take the time to look at the resolution But yes, let me hand over to Martin. Thank you.
Well, thank you, Natasha, and very informative. And I am, of course, disappointed that the board didn't support your resolution. But as you say, it's probably not too surprising. I have one question for you, Alex, and this is something that I run into when I speak to Equinor, and that is it is about their NCI target for 2035. They say that, oh, you got it wrong. You know, we have a plan to get there by 2035. So we are on track, aren't we? How would you respond to that?
Yeah, interesting. Thanks for the question. I think Pranav did a good job explaining how we think of Paris alignment. So we think of it from a global perspective. If you're developing projects which don't fit in a global carbon budget, then your strategy isn't Paris aligned. It's that simple. But I did dial in to Equinor's, what do they call it? The energy sustainability and growth presentation the other week. And I noticed, to be frank, with a little bit of alarm to start with, they spoke about their plan and how they're going to meet their 2035 NCI. So I did prepare a slide for this. So yeah, so this, I think this is showing now. Yeah, so this is our assessment. So the graph that Natasha showed from Equinor's disclosure, 2022 Energy Transition Plan, it shows themselves that they're not going to meet an NZE measure of an NCI. So that red dash line is their own targets, and that green line down there is the NZE as disclosed by Equinor. So I think the first thing is that a plan to meet their targets by Equinor's own disclosure is not a plan to meet a 1.5 degree scenario. The other thing we did is, and if you read our report, it's in the appendix, is we modelled the NCI for Equinor's portfolio. So we assumed they're going to meet the top end of their renewables target and the top end of their CCS target, and then we flexed what they do with oil and gas FIDs, because in our view, that's the more important part of a Paris-aligned strategy for an oil and gas company. And so what we see, as Natasha said, Equinor's now said they've got stable production out to stable oil and gas production out to 2035. So that black line there never gets terribly close to its targets. So in our view, they're not going to meet their 2030 or their 2035 target based off their current strategy. But if they cease exploration, so if they cease sanctioning new projects, then depending on how many they stop sanctioning, they may meet it. So if they stop in accordance with our recommendations, if they stop sanctioning new projects outside of Norway, then you get that yellow line where they don't meet their 2030 target, but they do meet their 2035 target. But of note, they still don't meet the NZE metric. So Equinor presented this chart on the right to show how they're going to meet their target for 2035. I think it's important to note they haven't disclosed, as far as I'm aware anyway, they haven't disclosed how they're going to meet their 2030 target. I think that suggests they don't, they're not confident that they will. But when you have a look at that waterfall chart to their 2035 target, there's a range of things that we didn't give them credit for, and I'll explain why. So the first one is optimized oil and gas portfolio. So I'm assuming that this refers to divestment, so divesting assets which reduce future emissions. So as Pranav said, divesting does not reduce emissions, it just transfers them to someone else's balance sheet. So in accordance with the Greenhouse Gas Protocol's corporate accounting standard, that is not a reduction. What actually happens there is you need to rebaseline your starting point for your climate target. And so that would invalidate the baseline for Equinor's NCI target. In terms of Scope 1 and 2 reduction, renewables and CCS, we gave them credit. We gave Equinor credit for meeting those metrics. The next one we weren't supportive of was the decarbonised energy wedge, I guess, or step. So decarbonised energy refers to blue hydrogen or gas power coupled with CCS. So we don't think this will actually reduce an NCI. If Equinor has gas power and it has CCS, then combining those together will introduce parasitic losses. which will mean that its impact on its NCI will be less positive than if it sold that gas power and it delivered that CCS as a service to a third party. So either combining those within its portfolio will actually have less benefit to its NCI, or it relates to additional CCS which isn't captured in its CCS target. So if they do increase their CCS target through decarbonised energy projects, then that will obviously help them reduce their NCI. The last category they have is non-energy or customer levers. So non-energy is change in the use of fossil fuels. So some fossil fuels aren't combusted. I think that's well understood. And as the energy transition happens, less of the produced fossil fuels will be combusted. We acknowledge that as well. Under this IEA scenario that most closely resembles Equinor's oil price assumptions, that's the announced pledges scenario that Natasha explained, there's only a 2% change in how much of fossil fuel or oil and gas production is non-combusted. So we did not see this as a material contributor. And then the last element is customer levers. So that's offsets. We didn't model offsets towards the NCI. Most of the commentary around offsets in Equinor's energy transition plan was very admirably about how they were going to constrain the use of offsets in meeting their Scope 1 and 2 ambition. So when we have a look at their waterfall, the big components of renewables and CCS, we gave them credit for, but we think several of those smaller elements aren't going to be material contributors or are inconsistent with their strategy or rigorous accounting principles. Hopefully that makes sense. Thank you very much, Martin.
Thank you, Alex. So I have a couple of questions for Natasha as well. And one of them is of course, for me as Norwegian and with the Norwegian government owning 67% of the shares directly, in addition to indirectly through other funds, so they're a large shareholder. And now that the board has recommended against your resolution, and which basically asked the board to follow the government's recommendations, do you have any expectations or thoughts on what the government should do at this point?
Well, I can tell you what I would like them to do, which I think is within my remit. I think as you have mentioned, and I'm so sorry for the banging outside my window. I hope it's not distracting you. But we drew up this resolution very carefully, thinking about also what the government of Norway, the largest shareholder, had asked Equinor to do very explicitly at the 2023 AGM. And we felt it was important to link it to that because we felt what we were trying to do was support actually what the government was asking for, and indeed provide that international investor voice in support of the board taking the difficult decisions. So I remain hopeful that the government may vote in favour of the shareholder resolution. I was actually reading again the government's white paper yesterday, and there's a whole section on how the government should, I think I can use that word now because this is Parliament directing the government with regards to its ownership responsibilities. It's a whole section on what it should be doing as a responsible owner. And it talks about how it needs to use its vote responsibly. So that doesn't mean always going along with what the board said. It actually says that the government should also ensure that it's appointing the right board and removing boards which are not meeting its expectations. And there's a sentence there, and I would like to quote it exactly, but I'll paraphrase because I can't remember, but it was something around if there's a diversion from what the government has said as its expectations, the board should be thinking about using those voting powers. I would say this is exactly what we're dealing with here. This is a diversion. from what the government has set out the last AGM. So I hope they will use their voting powers in this case. Yeah, that would be my answer.
Well, thank you. And another question for you, Natasha, is also, I suspect that at this point you will start to talk to, or have already started talking to, other financial institutions. I don't know if you can say, I mean, what are your, do you get positive feedback, or do you expect any support from other financial institutions?
Again, I can't speak for others, and also just because the resolution has only just been formally published, every institutional investor, including ourselves, have quite, rigorous internal control processes when they're considering shareholder resolutions, etc. So it's hard to know at this stage where what the balance will be. But I would say again, we obviously, Sarasin has been a co-lead on the CA100 Plus, so we have been speaking very closely with the other leads as well as the broader engagement group. And, we've attended meetings together like Equinor's ESG event in Oslo earlier this month, where you could hear what other investors were saying, some other very large investors, Norwegian and others. So I don't think we're an outlier in terms of our expectations of Equinor. I think actually what we've put in this resolution, as you say, it mirrors what the government as the largest shareholder has already asked. It mirrors what Equinor has already committed to. We're simply asking Equinor to deliver on its existing commitments. And it's very aligned with, international investors who are themselves committed to do what they can to align with the Paris goals. So I would hope we would get a pretty good vote coming out in favor of this. I do note that at the last AGM, Greenpeace had a resolution which did get support from one of the major proxy advisors. So that's also another consideration for us, is whether the proxy advisors will come out in support of this resolution.
Well, thank you. And I think with that we'll draw this to an end. And I can just I'll cross my fingers and toes and everything I have in.
Martin, there's actually a question which maybe I could answer quickly on the Q&A.
Yes, go ahead.
Thank you for the question. So it's, why do you think the board has recommended against the resolution? Yeah, I mean, I think, to be honest, for the board to have supported the resolution would have been a step in a direction that they've never taken before. I can't say that 100%, but I think it is highly unusual for the board to support shareholder resolutions at Equinor. Certainly, we've seen that elsewhere. We've also seen in cases where we have personally been involved, for example, at HSBC, situations where you file a shareholder resolution, you have a very productive and constructive conversation, and then the board actually comes out with a very similar resolution themselves, which then they get behind, and that means the shareholder resolution can be withdrawn. That didn't happen in this case. But, a commitment was made to us that they would consider it very carefully. And they have, and they've recommended against. So I can't tell you why. I'll need to go and look at those AGM materials and see what rationale they've provided. But I struggle to understand it, to be honest. Apart from, I would mention, the most common reason for them not being or taking a more robust approach to pivoting to 1.5 has been the question of energy security. This is clearly a very sensitive issue, but I would make 2 points about it. Firstly, or 3 points. Firstly, in terms of the timelines of the pipelines and the capex, the investments that are going in today will be delivering oil and gas, in future decades, all the way to 2100, as we've seen from ACCR. And so by that time, I think we'll be well on our way on the energy transition. So harder to say that we'll need that oil and gas, as we've just looked at. The second point is that I think from an energy security perspective, certainly in Europe with the Repower EU initiative following the Russian invasion of Ukraine, the emphasis now is a faster transition away from fossil fuels because renewables are more viewed to be more secure. They're domestic, they're distributed, you don't need to rely on importing. So actually, I think we're going to see a faster transition. We already are in Europe as a result of that. So energy security is pushing us the other way. I maybe should stop there, but because we're coming up to time. But I do think that it's a bit of a red herring, the energy security argument, not because I don't think energy security is important, I do, but I don't think doubling down on fossil fuels that puts the climate at risk and actually global security at risk is the right way to achieve it.
Thank you. That was a good and clear answer. Now there are no more questions, so I think that now will be the time to draw to an end, and I want to thank everyone that have participated. As I said in the beginning, we will share the recordings with you, all of you, afterwards, and at least I hope to see some of you also voting in support of the resolution at the AGM. I have my one share in Equinor, and I will definitely support it with that one. And with that, I will say thank you and goodbye.